So a little bit about us, we are an impact investor. We've been around for over 20 years, focused entirely on emerging and frontier markets across both private debt and private equity. For any of you that have heard of us in the space, we are active across the region, across Asia, Eurasia broadly, Latin America, and then also in Africa. And we have a emphasis, at least internally, on trying to bring institutional investors into the fold of impact investing. And we focus on returns first focused impact investments with a heavy tilt on financial inclusion. So when we first started, we were purely in the microfinance space. Then, of course, as that industry evolved over the last 10, 15 years, we expanded our focus to be the broader financial inclusion market across both private debt and private equity. Currently, of our AUM, majority of that is on the private debt side. But on the private equity side, we've managed and raised two successful funds, of which we made 25 different investments across Fund 1 and Fund 2. Fund 1, we've exited all of them. And so we have a fully realized track record. The last two assets are pending distribution. So, we have that PE track record in the impact space, which has been a foundational element for us in the upcoming fund, which I'll talk about. And a quick deep dive on the private equity side, because that's where we'll be focusing on going forward. But we have, like I said, launched two funds. 2009 was the first vintage. It was an $82 million fund and global, truly global in nature across LATAM, across Asia and Africa. 16 different investments out of it. Fund 2 was 52 million, a more recent vintage with a final close in 2015. We have 8 active investments from that, had our first partial exit in India out of the existing investments. Currently, our active portfolio is across Georgia, Armenia, India, Sri Lanka, China, Panama, and Colombia. So very, very diverse from a geographic standpoint. And this is specifically for PE. Private debt, of course, we have a whole list of other countries as well where we are active in. In the region, we're also active on the private debt side. We've done investments into Central Asia. We also have an active investment in Moldova. Happy to speak about that or introduce you to my private debt colleagues if it's of interest. But the purpose of this discussion was to try and see how, from private equity standpoint, at least, given the work we've done, given the extensive track record we've built up, we started thinking through how we work on impact initiatives that are driving a lot more rigorous impact from a financial inclusion standpoint. And at the same time, we started taking a look at our existing portfolio. And we saw that across the board, there's a high degree of understanding that migration, displacement, whether it's as a result of climate, conflict, economic reasons, is very much a part and parcel of everyday operations. If there's, for instance, on the climate side, if there's domestic migration because of climate, every time there's a flood or every time there's regular seasonal changes that require our end borrowers or end clients to move from one location to the other, that's climate migration. Certainly from a conflict standpoint, we've seen that happen either in post-conflict areas or in immediate aftermath of conflict. In some countries, we've also seen it from a rural to urban migration standpoint. So all this to say, within our existing portfolio, when we did an analysis, we saw that there was very clearly, at least an awareness that migration and displacement are increasingly becoming a larger part of it. What we did based on that then is asked a series of questions to over 20 different financial institutions across the globe, especially in countries where there's high volumes of displacement. And so as a part of that process, the findings were pretty interesting, and one was that as the numbers in our portfolio showed, over 90% of the respondents, and these were CEOs or CFOs or CEOs, the C-suite of these financial institutions, over 90% came back and said, look, we know we have displaced communities within our portfolio just by virtue of working in these regions. But what we can't tell you is what that exact number is because it's not a systematic approach. It's just an opportunistic play because we operate in regions where there's protracted displacement. And so we took that, this was, of course, about 3 years ago, the research that we did. We took that a step further and then asked what types of products would allow you to create a more systematic approach to serving, say, refugees or internally displaced persons or migrants. And there also, the overwhelming response came back with saying equity, some form of concessional capital in the form of debt, maybe some amount of technical assistance facility, guarantees, debt. So it requires a whole host of instruments that go towards it. But I think fundamentally, to start building up that process within a company and to institutionally develop outreach mechanisms, underwriting mechanisms, KYC, AML processes that will allow them to serve displaced communities. To do that, they initially needed a long-term partner, ideally with risk-taking capital, which is why we structured a fund as a private equity fund. And so this slide just talks about the portfolio characteristics, what the fund concept stands for. Let me speak to that a little bit because we are in the process of launching the fund. It's not launched yet. We expect that it'll launch by Q1 or Q2 of 2023, so it's imminent. But it's called the Displaced Communities Fund. And we expect that this will be, the first in a family of funds. So right now we are targeting $50 to $75 million overall in committed capital, but we expect that for Fund 2 and Fund 3, that it'll increase higher, go upwards of $100 million in committed capital, and allow us to take active either minority or majority stakes, in all cases with a board seat, into financial institutions that are either already serving displaced communities or with our support will be willing to make commitments and implement pilot projects and schemes that will allow them to serve displaced communities. I will say that currently, in the way the fund was structured and given the volumes of displacement, majority will be deployed in Africa. Having said that, though, with the recent war, we have also started looking at other countries which will be able to serve, say, Ukrainian refugees or other types of migrants within the region. And so we have an active presence in Georgia and Armenia, and we have started looking at ways in which we can facilitate that. And so it's a whole list of countries similar to our DNA. We have a very diverse geographic pool that we are actively sourcing the pipeline from. It's primarily financial institutions, what we call inclusive financial institutions, but it can be MFIs, it can be banks, SMEs, specialty lenders. We've done it across the board. And then there's about 4 or 5 different verticals that we've identified where support may be required or new schemes or processes may have to be developed. So there's customer outreach, which we spoke about. There's product design. There's underwriting capabilities, and then there's hiring also from these segments. And then there's an oversight and measurement element, which we'll also be supporting with. To some extent, given the importance of technology to play a key role in this space, we are also sourcing pipeline from tech companies, primarily, fintech, which can work closely with financial institutions to help scale these services. In terms of the fund size, it's or the individual deal size, it's about 2 to 3 million on the low end, going up to 8 to 9 million on the high end. Average ticket size is about 5 to 6 million. Our hold period, because we want this to be a longer term partnership, our hold period is about 7 to 8 years within each investee. And there is the potential for technical assistance that comes in alongside each investment to allow for acceleration of some of these initiatives and scaling of some of these initiatives. So I'd say that's the entire fund in a nutshell. Beyond that, some of the frequently asked questions we get is, are there already enough financial institutions doing this at scale? The short answer is no. It's a handful, but that's why we come in. That's why we think the opportunity is from a private equity standpoint, because we believe there's a very clear market and a segment out there, one that our financial institutions will look to tap into, and we're trying to help them figure out how. So it's not a requirement that the FIs that are eligible for this fund already serve refugees or IDPs or migrants, whatever the local context is. But it's important that they are willing to work with us to make commitments and that there's stakeholder alignment in doing so over our hold period. And, of course, there'll be impact targets, impact commitments. As a fund manager, we are also linking ourselves with impact achievement in terms of our carry. And so it's very much impact focused fund, which is aiming to develop a commercially viable case for serving displaced communities. So it's, let me pause there and see if there's any questions, but that's largely the overview I wanted to provide today in terms of what we're working on.
Great, thank you very much, Sima. It was very interesting. Maybe I ask if there are any questions, because this is a good opportunity, and I know that you have to jump out from this call in a few minutes. I don't see anybody yet having a question. Maybe I will ask then, if you, what would be for you the success? Who would you approach as the institution, and what will institute like a successful candidate to work with you on this fund? What would you look at?
Yeah, I'd say, the first thing would have to be stakeholder alignment with management, board, shareholders, that they are willing to focus on displaced communities as a segment. And I think we've seen that in most cases, this has been a positive. We've, like I said, in majority of the cases that we've spoken with, there's an awareness that this is important, that this is where the business can focus on. And in a large number of those cases, again, there's a willingness to make commitments to do so. There's a willingness to figure out exactly how this is being done. So that's step number one, now, if you say the screening criteria upfront. Beyond that, what we are looking to do is, because it's like a proof of concept that we are looking to develop. So the types of companies in terms of sizes, in terms of parameters, because we want to take active, either minority or majority stakes, typically minority, on the low end, total assets of about 20, 30 million, on the high end, about 300 million. So anywhere between 50 to 75 million on average is the sweet spot. But obviously there is a broader range in terms of size. That's one, ideally having an established track record on the profitability side. So the typical growth equity plays that you would see a private equity fund coming into, I think that'll be very much what we focus on. But the upfront determining factor and the differentiator is the stakeholder alignment piece.
Great, thank you.
And Katja, I can stay on for the next actually 15 minutes till 8:45, and then I'll drop off.
Perfect. Thank you. That's great. Question, welcome. If no question, I would ask another one. What would be your imagine or perceived return on investment that you are?
Yeah, it's a good question. We are targeting a net IRR, and I don't recall if the fund materials are, but we're targeting a net IRR at the fund level of between 10 to 15%. And so at an asset level, we're talking about 15% plus from a return standpoint, which typically private equity is 20%. So it's not your traditional 20% plus private equity return product, but it's still commercially viable, in that we are targeting 15% plus asset returns.
Thank you. Oh, I see question from Linus, and and Nadia. I don't know who was first.
Sorry, Nadia, please.
Nadia?
No? Oh, you're on mute.
Sorry about this. Thank you so much for a very interesting presentation. I have many questions, but we won't have time to discuss all of them now. Maybe I'll take it separately with you. But I was just curious. So, these countries that you mentioned, how is it that your fund establishes the contacts? Is this then companies reach out to you, or you have like a team of people who do research and decide? Basically, how is the lead generation? What's the lead generation process for you?
Yeah, good question again. I mean, it's overall, DWM, the way we are set up, it's we are close to 50 people now, 50 full-time, and then we have a few contract staff. There's about 20 of us in the US, which is where I am based, but majority of us now are in markets. And so we have offices in Tbilisi, in Delhi, and we have colleagues based across, Kenya, Botswana, South Africa. And then in Central and South America, we have colleagues, about 7 or 8 of them spread across, Mexico, Peru, Colombia, even you name it. We have a very geographically split up presence. And through that is where we get our sourcing. So we have a lot of on the ground presence. And like I said earlier, we have a track record in the financial inclusion space of over 20 years, which means because we've been working with financial institutions over this entire period, we've developed that network of FIs over and over again. And so a lot of the ones we go to are either financial institutions we know, are from that network name that we know, or the CEOs have gone to set up something else, the founders have gone to set up something else, we followed them. So we have over 200 in our global network. We have about 80 to 90 active investees at any point in time. So that forms an automatic pipeline. So I'd say 90 to 95% of our private equity pipeline at any given point in time is proprietary. So it either comes from our DWM debt relationships, on the ground relationships, or the private equity owned relationships. Small amount could come from, advisors or something like that, but it's primarily proprietary relationships with either companies, founders, or with co-investors, who are looking to go in.
Thank you. Interesting.
Sure.
Thanks a lot.
Yeah, and probably my turn. So yeah, thank you very much for interesting presentation. My question is, there was no investment in European Union, if I am correct. Maybe there is a particular reason for that. Thank you.
Yeah, it's and actually there's something Kasia and I also were talking about earlier when we had a conversation. It's largely based on limited partners, the investors into the fund, because they have pools that come in specifically for certain countries, that have characteristics below a certain GDP per capita, whether they're classified as LDCs, non-LDCs. So that's the main reason, Linas. Of course, the conversation we should be having now, especially in the aftermath of the war or the ongoing war, is what countries should be focused on. Where is there the ability to serve, say, Ukrainian refugees at scale? And it's ongoing, but given also the recency of it, I think we don't have a clear sense yet. But that's the reason you'll see historically, I think mainly driven by limited partner and investor regulations, that it's purely emerging and frontier markets.
Thank you. More questions from? Nope. Like, I think the Linas and Nadia, your hands are the previous one, or if you want to have a follow-up question. Nadia, no? Okay, great. So if there are no more questions, if there will be questions afterwards, it's also possible that you do just write to Suma or to me, and then I try to give it to Suma to give us the input in writing. But thank you very much. It was super interesting, and I think you kind of presented a completely new world to us of how it could look like, and what is the focus right now on the impact investing side. So maybe to kind of change a little bit the pace, but moving to the microfinance world, which Suma could be also interesting for you. I asked Martina and Linas to prepare kind of an overview of how they would see how the instrument for microfinance could look like if we're looking at supporting refugees, because we have a lot of conversation during this year, and I thought that this group would be a great kind of central point to have it on the table and to discuss it with the broader group. So Linas, would you like to start with the ideas that you have? Thank you.
Yes, sure. Just a second. I will share my screen. So And hopefully you should see my presentation. Yeah.
Yes.
Great. So I shortly presented myself, so I probably will skip those slides which are about our company, Novative Finance. As mentioned, we're focusing on micro lending to companies. We have around already now close to 2,000 of those in our portfolio. And growing. So the challenge which we were investigating was exactly how to create how to integrate migrants into economy, how to create incentives for corporates to hire those ones, or for entrepreneurs to really start businesses in an easier way. And probably we can refugees and migrants split into two categories, if I may say so. Initially, sorry if this approach will a little bit contradict your market situation, but it's just subjective opinion of ours. So the way to split them is into two groups: entrepreneurs and employees. So what we see now in our country, that there are businesses, let's say from Ukraine, which would be willing to reallocate due to the war which is happening there. And then they have a demand for startup investments or for some business reallocation. They might demand some business credits. And of course, for them, it's very kind of more complicated to integrate into economy because they do not know about the taxation. They do not know, how to administrate the business on the daily basis. So that support would be very much helping for them to start operating in the new country. Now, on the other side, we have employees. So it's like the biggest, I would say, part of the of refugees and migrants. So those are the ones who demand for the work. They might need consultation, supporting in finding it, supporting in finding the job. And another thing which we also see in our country, what is the big headache for refugees and migrants, is to support in renting a flat. That is a very tricky topic. From perspective, I think that lots of you who had this situation in your countries are also familiar with that. Nobody wants to rent flats for refugees or migrants because there is some unpredictability for how long it will be. There is some cultural kind of, let's say, worries in some cases. So for them, it's really a struggle to rent it. Just that, it's governmental support might be here needed in order to fix it. Now, the context by having this challenge and by having those needs is this, that majority of migrants are exactly employee type of persons. So they are looking for the job. They want to rent a place to live where, and they want to work in order to earn money while they are in this refugee status in the new country which they appeared. That's a focus segment. With the entrepreneurs, it's more a minor thing. It's still, of course, important that it would be support to migrate the business from the kind of primary country to the new country, but the segment is smaller. And in general, to start the business, there are governmental programs which support starting of a business. So hopefully they might be tuned in this case. But I would think still that 95% plus of people who are with refugee status, they are very much interested in finding a job. They are this type of persons. Now, another context is that each new program implies complexity. So how we see it as a participant of several governmental programs, both European and both local, it is, in our case, it's much more effective to adjust existing either portfolio guarantee programs or financing programs instead of establishing a new one. I mean, that might be the way, but it might be going in parallel, that there is a new one, and at the same time there is an adjustment of existing programs, like taking into account the refugee aspect of a business. But still, it's better probably to adjust the programs. Another context thing is that mid-large companies have little problems in getting credit. So when we think about incentives, how to persuade companies in the market to hire refugees, how to persuade them. what might be governmental instruments that the company which is doing business, regular business, they would be interested, or they have some facilitation in hiring refugees. That's basically the challenge. And while looking at that challenge, it seems that mid and large companies, they do not have a problem in getting a credit, while the small SMEs, they struggle to get a credit. So when we talk about the portfolio guarantee as a tool, which is very widely used, let's say by EIF, it is much more, as a tool, it is much more effective when we talk about small SMEs. For them, the opportunity to be under the guarantee and as a result to get a credit is a benefit. For mid-large companies, I mean, not such a big one, because they might get a credit and they deal with the big banks, and the portfolio guarantee is not really something which is very much affecting their business. Non-bank, another context thing, the last one is non-bank credit institutions are more active in micro SME crediting than the large banks. That's definitely in our region, and I very much believe that it's all over the Europe, from what I know. But non-bank financial institutions, they struggle to attract funding and capital. That's what they very much struggle. And even portfolio guarantees, which are provided by EIF, are very much viewed by the context that how much it helps to reduce the funding cost for such institution. And of course, it helps. So as an example, I might mention that, the credit risk is relatively low in SME segment. I mean, of course, it is there. And of course, the portfolio guarantee, it very much covers that credit risk, which is still there. And it is a big benefit of that. But as mentioned, there is a big part, the other part of that crediting business, which is how to get cheaper funding and how to get equity, which is a necessary thing for growth. And that's where portfolio guarantees, the second benefit of portfolio guarantees, you are much more attractable for investors when you get that, when you have those portfolio guarantees. By itself, the risk is not big. And the portfolio guarantees are not somehow very much in kind of pushing companies to act more aggressively. For example, when we are micro lender. When we look at the refugee segment and we are considering opportunity to lend money to them, the problems are those that it's very difficult to predict the risk. If we want to lend company to some, let's say, Ukrainian company who is relocating to Lithuania, now how to calculate that risk? I mean, the regular portfolio guarantee still leaves some risk on the lenders, which is very logical and good. So basically, the lender is evaluating the risk, and our logic is this: okay, they do not have any assets here, and you cannot probably take even the surety of business owner because the owner is a temporary person here. He might very easily reallocate back to his primary country. So it's very difficult to calculate the risk. And it's like in case of insurance companies. Insurance companies are not working with the risks which they cannot predict. Yeah, they are not providing guarantees, insurance, if they cannot calculate the risk, or if the risk is very hardly predictable. So with migrants, it is relatively hard to predict it and to calculate when we talk about loans which do not require any collateral and which fully rely on the surety of business owner. So what suggestions there might be? One thing is to adjust the existing portfolio guarantee programs by increasing the guarantee coverage ratio if customer has more than X% of migrants in its staff. So that might be the thing. Okay, let's assume there is a small company which is, let's say, doing, let's say, some construction work. If they would know that, okay, it would be easier for them to get a credit if they have more migrants, well, that might be, some kind of persuasions for them to have more of those. There should be business incentives to hire migrants or refugees. Of course, the most direct one is adjustment of state taxation. By either it is taxation of income tax or some other tax. I mean, that's the most direct incentive for any business that, okay, if I hire refugees, then okay, I will pay less taxes on those, or I will have other kind of incentives provided by the state to do that. Now, but that's of course the state topic, and we are not here kind of, we're not dealing with that, and let's focus on the things which probably we can affect. Not direct one is cheaper credits for companies hiring migrants. That might be the thing which is very much wished by businesses. They want to get credits cheaper, and that might be a thing for them, kind of a benefit that, okay, if I would hire, refugees, the cheaper financing would be accessible for my company. Now, how to make those credits more affordable? So there are several possible ways, and again, subjective ideas, but I will just quickly share it. So it is one thing is partial guarantees on bond emissions for non-bank financial institutions, with condition that the X share of funding would be used with EIF or state agency programs, including the refugee hiring programs, and with some limited max margin on the top of that funding cost. I will provide in the next slide the example. There is very similar program was done in Lithuania during the COVID period, and it showed very good results. Now, the other one is that there might be special bond emission dedicated to finance non-bank financials, like financial institutions, which are providing, those benefits which state agencies are very much interested in. There might be interest compensation programs. For simplicity, it even can be administered by credit institutions. There would be no need for state agencies then, to deal with interest compensation for each customer. But financial institutions might be administrators of that, and that might be also a kind of benefit which would create these good incentives for companies in the market to hire refugees, and the last one is equity programs. That's a big headache, especially for non-bank financial institutions, because it is done in a way that it's very difficult to attract equity. Even state equity programs, which are for startup communities, they exclude credit businesses as the possible direction of investment. Therefore, lots of venture funds who are partnering with the state, they even cannot invest into credit institutions, non-bank financial institutions, and therefore it's really, and when you exclude the venture funds which are working with the state, well, that's not so much left in the market. The biggest one, the most active ones, definitely they try to use state instruments in their venture activities. And the last example of Lithuania is that I mentioned that there was this cheap money program. The state agency, while trying to make credits cheaper in the market, they provided funding for financial institutions for 1% rate, with a condition that those financial institutions would provide loans with a maximum 7% rate for end customers. And that worked very fine during COVID period, when there was a challenge how to make credits more affordable, accessible for businesses. So that's how it was done. It might be even adjusted. I know that state agencies do not want to be the direct funding providers. They want to use their instrument as the leverage and to attract private money into the into this investment process. So therefore, the proposed scheme might be that the state provides as a guarantee, and that the private investors, either banks, either investment funds, they are providing loans to financial institutions, which are in that case providing the benefit for end users. For example, issuing credits for refugee companies, or for companies who are hiring refugees, or for any other important program which is a target for EIF. Let's say, is it a green course, or is it micro lending, or is it other priorities which are there? So my point is that I very much think that it's good that, in summary, it's good that the state, that the agencies like EIF, EIB are very much using those guarantees as the tools to promote one on another policy or behavior of the market. But if they would add up funding or equity more actively, that would, which is the biggest actually challenge for the financial institution in the market, especially now in our this environment when the interest rate goes up, then it would be much more effective, I would say. So I just encourage not to limit those activities with guarantee instruments. Equity and funding are very much very active tools which might be used there. And the guarantee might actually be used as the tool to attract private money, private investments into financial institutions which are delivering the goals of EIF and EIB. Thank you very much. That's it from me.
Thank you very much, Linas. I think maybe Martina, you would go next, and then we will have some time to discuss and take questions.
Okay. I need to show a window, right? Not a desktop. Yes. Or no? Could you see now?
Yes, we can see.
Okay. So I have prepared one, let's say, practical presentation about what I think could be used in the support of refugees and migrants, because actually less than 1 year ago when we started this group, I really expected to find a lot of answers for Bulgaria, but obviously there are much more questions than any answers. So these are my answers that I have learned during these couple of months and what we have done during these months. So in current presentation, I have a couple of assumptions. It's good that Linas actually focused on employee type of refugees and migrants, because my focus is other. So the focus is on migrants and refugees who have recently arrived in the host country and who are not part of long-living migrant communities. Because I know there are already solutions like ADI, like MicroStart. They're offering loans to communities. But here I think the most challenging thing is the recently arrived migrants and refugees. Also, my focus is on those who would like to become self-employed, because this is interesting for us as financial institution. And what I suggest really is that we should look at the migrants and refugees as simply vulnerable group, because I think that there are general solutions that could be adopted to vulnerable group, no matter which kind of vulnerable group is it. Okay, so the main principles for me are the effective solutions in dealing with vulnerable groups feature integrated approach. This means that only one MFI or only one NGO or foundation or the state alone could not achieve the results. We need partnerships, we need really an integrated approach. Also, the support of entrepreneurs from vulnerable groups incorporates two main aspects that are non-financial support. It is crucial, and it's needed because these entrepreneurs generally lack at least one, in the most cases, more essential skills. Also, appropriate financial support through tailor-made funding. Here, my idea is that this tailor-made funding should be not grant, because I strongly support the idea of financial instruments than grants, as really grants, if you're providing to refugees or migrants grants, then you are not able really to assess what is their motivation to stay, to work, and to develop. So this is my idea here. Where are we now? I would like to share with you the key moments in the recent months for Syscredit and Microfont. So far, we have 3 startup businesses of refugees financed. And here, I must say that as refugees were not our target group so far, these were just good entrepreneurs and by chance they're refugees. So it is not intensively looked as client type. Also, we have 1 refugee employed at Syscredit, and this really helped me see how motivated and fast learning are they if they would like to stay and develop here. So our employee, she's from Ukraine and she's with us for already 5 or 6 months. And she speaks Bulgarian, she understands Bulgarian, she's dealing with documents in Bulgarian. So I really see a great motivation. Also, 1 application under a grant program of Council of Europe Bank. We use this opportunity just to see where we are. Unfortunately, it was not successful application, but still it is a room for such kind of programs and applications by MFIs. Kasia, could you hear me?
Sorry. Yes, I can hear you.
Okay, because I'm not sure if everything is okay. Great. Also, we have a great experience in the implementation of financial instruments, which is important here, in support of entrepreneurs from vulnerable groups. So far, in the last 3 years, under a program that we are implementing, we have about 70 startups who have received funding from these are entrepreneurs from vulnerable groups, which means youth, also unemployed people, people with disabilities, and most of them even didn't have 1 day of history as a company. So we really learned a lot. Also, which is very important, that Syscredit and Microfont are recognized partners for NGOs that are dealing with the topic of social entrepreneurship and financial inclusion of vulnerable groups. And what I'm personally proud of is the strong advocacy at national level to raise the awareness of the importance of microfinance sector and the need of financial instruments in the next program period in support of these vulnerable groups. Challenges for MFIs in dealing with migrant and refugee entrepreneurs. We know these challenges. We have been speaking about them for months. But again, just to briefly outline them, the first thing is entering into riskier client segment. Of course, this is very challenging. It requires adjustment of risk policies and procedures. We saw this with the financial instrument that we are implementing for vulnerable groups. It really needs a lot of adjustments to the general workflow. Also, IT amendments, including access to credit bureau of the country of residence client, when we are talking about refugees and migrants. Many MFIs have fear from potential increase in non-performing loans when dealing with vulnerable groups. This is normal. And again, this could be also a burden for attraction of investors in the future. Also the lack of collateral and guarantors of the clients who are refugees and migrants, and lack of language and entrepreneurial skills of the target group. all this, I must say frankly that make microfinance institutions be aware, like preferring not to enter into this segment, because in general we could follow our mission, for example, financial inclusion and job creation, by dealing with not so challenging groups. So here the big question is how to incentivize MFIs to deal with migrants and refugees. Let's see how could we do this from my point of view. On the first place, there should be a grant support for the non-financial services and building of partnerships between NGOs, MFIs, and state structures. The pilot PAFMI project was a good start, yes, although the focus was not only financial inclusion, but let's say general inclusion. So projects for financial inclusion needed to be in a battle, let's say it like this, with projects that are for healthcare, for housing, and maybe this would be considered as priority. Let's see in a couple of months which were the projects that benefited from the grants under PAFMI, to see if I am right. But again, it was a good start. Also, appropriate funding instruments that allow low interest loans. This is very important. Also, long grace period, long repayment period, and something maybe new for MFIs, but for us it's not something new, and I think it's important. The shared risk. Here are the features of the risk-sharing microfinance facility that we are implementing in the moment. This is a financial instrument that could be adopted to this target group as well. For Bulgaria, the problem is that the financial instrument is actually going to end in the end of 2023. And the ministry is not considering at the moment to keep it for the next program period, which is a problem because I think it's really successful. This risk-sharing instrument is under national operational program and is co-financed by the European Social Fund. Up to 85% of the funding is provided here by the Fund of Funds at 0% interest rate. Also, up to 85% of the risk of non-payment is covered by the financial instrument. Here, the interesting thing is that it's on loan-by-loan basis and there is no portfolio cap. So it's really more effective than guarantees and is forcing MFIs to take as much risk and enter into as riskier segment that they could. Also, the fees on the loan are covered by the program. And MFIs receive annual management fee by Fund of Funds. Again, here there is absolutely great grace periods that could be offered to clients, and is up to 24 months, and also up to 10 years repayment schedule. This structure of the financial instrument is allowing MFIs really to offer the best solution for clients from vulnerable groups. And here I said, here I put an action plan, but it's something like that. I'm not sure what is it. This is just something that I'm thinking about. What we should do after this working group ends. So we should continue mapping good and also innovative approaches in the financial inclusion of vulnerable groups. Also something important is the advocacy towards financial instruments for support of vulnerable groups at European level. And of course, they're designed at national level. Here, I'm not sure if we should focus on the fund of funds where there are such structure in the countries, or we should think about something like centralized application for the whole European Union. These are just like, let's say, visions for the future, maybe. But for instance, we should think about how to make financial instruments available for more MFIs in Europe. Of course, showing best practices and good examples, this is always a good approach in finding solutions, in promoting what should be done. Joint applications for grant support for building partnerships and covering the non-financial services at national and also cross-border. Maybe we could make joint applications. This grant support should, from my perspective, cover the language skills of refugees and migrants, organizing academies for entrepreneurs, and other services, of course. Also, IT solutions for risk assessments to be made available for free, maybe through a grant program or other. There are already such IT solutions on the market that you could easily access the credit bureau, for example, in Ukraine, to assess the credit risk of refugees from that country. And here the question is why MFIs should invest in this to put it in the IT system. Again, the incentive should come from some grant support, I think. And last idea about something like a guarantee fund could be organized, something like this. At the moment, I have negotiations with actually with the Municipality Guarantee Fund in Bulgaria. And I really would like to start something like a pilot and see if they could provide some kind of guarantee for such portfolio. And this is from my side. I think, okay, let's see, where am I now? Kasia, could you hear me?
Yeah, we can. We could hear you.
Okay,
fine.
Because I choose a very strange view of the presentation actually, and I'm not sure where am I at the moment. So it's good that you could hear me. Okay, and it's okay.
No, it's. I think your presentation was great, and we could hear you fine. And
okay,
it's thank you very much for sharing. And great that Kim wants to speak, because I wanted to actually put the light a little bit on you or Anna. So volunteering to ask a question would maybe be a good moment to start the conversation. So please go ahead.
But I wanted to first ask Anna, would you like to go first, or should I come with a few comments from my side?
No, Kim, go ahead.
Yeah. Okay. I mean, yeah, I thank you indeed very much to both of you for these presentations. Very interesting. I actually just have two maybe questions or comments and then a question. The comments is one with regard to the repayment structure and the grace periods and the flexibility you're proposing. I actually wonder if that is, it's a question whether that is really the approach to take with migrants and new entrepreneurs, because you are, at the end of the day, I think a repayment schedule should always be scheduled or structured according to the underlying business model, and therefore it's maybe more important to inbuild more flexibility in possible rescheduling, close and also to discipline on the one side, the entrepreneur, but on the other hand, have more flexibility on restructuring and rescheduling of the loans. I think we've seen that now, and we're doing a study in Portugal at the moment, where we see that one of the big problems is actually that the young entrepreneurs, the micro enterprises, they are left alone when they get to the restructuring of their loans. So there's not enough flexibility, and also then often they get behind. Then the banks are paid out through the guarantees, and then they are left with the debt. The banks have been, they have got their money back substantially, and entrepreneurs are left with a problem. So maybe more sort of a comment whether one should not think more about flexibility. But what I really wanted to ask you is, we speak, I think a lot will be about non-financial services, as you also said. So how, we have already micro credit programs all over Europe, and that's really our topic, Anna, no? How then to adapt those microcredit programs? What needs to be done and changed in those, and improved maybe, to make it them more suitable for migrants? Of course, that's our topic today. And there, I wondered, is there a study out there already on different models for non-financial services? Because at least, again, my experience, and mainly experience in Portugal, is that there's a great difference of models, of actors. It's a very broad market. And I wonder if one could, at least for migrants, try to focus in and say, okay, which are really good practice models, and how can we learn both from a structure, from a content, from a deliverable model, how to go about that. So that would be my specific question. Thank you.
Okay, maybe to start first, in Bulgaria we have very developed NGO market, which means that there are many NGOs that are focusing on different vulnerable groups. In the last year, I'm meeting with many of them who are focusing now on refugees because of the crisis in Ukraine. And before we had many Syrian and Afghanistan refugees. So these NGOs, the one group is providing support in helping these people finding a job and opening a bank account. Also finding where to live. This was very important for refugees from Afghanistan and Syria. The most of them were not so well educated. And there is a big difference with the refugees from Ukraine, that about 70% of them, I think was the statistics, is they are very well educated. So they need support in only finding, for example, kindergarten for the children. And they could easily find a job, actually, if they really want. For these more educated refugees, there is another NGO that is supporting them in their education, in having lessons in language, which is absolutely important if you want to stay here. Of course, the language is crucial. And when we applied together with this NGO under the PAFMI project, then we have idea this grant support on the one side to be to cover academy for entrepreneurs, because they are very good in educating people in entrepreneurial skills. And this together with the language skills, we wanted to be like academy for 3 months. The person to develop language skills and also entrepreneurial skills, and then these educated people to receive funding from Syscredit to start a business. So this was our idea, and this is what in Bulgaria is offered.
I had basically the same question in terms of the business development support. It comes from our here, let's say, focus right now as well in terms of the study, because we think that you know, in terms of what AMIF maybe can offer in the future is to somehow cover that non-financial support that is needed, and you know, hopefully our study will also identify specifically in terms of the specific needs of migrants what it is, and as Kim mentioned, what kind of models are popular, why, you know, what are the advantages of one or the other, and how can you explain us a little bit in terms of the of your case? Is this non-financial support provided by yourself, or do you use external experts? How are they are they volunteers, or what's your, let's say, practical lessons learned with this topic?
Here at Syscredit, in general, we are providing non-financial services to, let's say, general entrepreneurs, including youth, including unemployed. These are really specific groups that need special attention. But for refugees and migrants, I believe that MFIs could not do the job alone. This is very challenging task, and it's not easy. It needs time. It needs resources, because the prime business of MFIs is not the non-financial services, you know, it's the financial part. So we definitely need a partner in this.
But I think, Martina, I think we see a similar situation in other countries. But I was really wanting to get at is, if you like, we often see a heterogeneous picture of non-financial service providers. You know, they are often under various public programs. They're you know, subcontracted under call for interest, and there's really the question: do you see a need to maybe establish some kind of a training for non-financial service providers, and maybe even a certain, I wouldn't call it standardization, because of course it's very different, but some notion of you know, which are common approaches, best practice. Is this something you've seen, and maybe to the rest of you in countries? Of course, wherever we see a very big player like ADI in France and so on, I'm sure that then there's a lot, by definition, a lot of that kind of standardization and cross-fertilization taking place. But maybe in other countries less. So that's really my question.
In general, I'm a fan of building a framework. I believe that you should have something standardized as an approach in dealing with vulnerable groups as non-financial services that should be adapted to different vulnerable groups. Because you could not make real impact if you are resolving on a case-by-case basis each case. So I really believe that a standardized approach is something good. For example, in Bulgaria, I think that they're really experienced so far, so they know how to do things in general. For example, some of them for academics, for entrepreneurs, some of them for helping refugees and migrants in the first steps of after their arrival. And I think that the focus should be on building these partnerships. not support to NGO and another support to MFI and another support to the government by the EU, but some partnership approach that we have already such example, as I said, the PAFMI project of Council of Europe Bank. It offers partnerships to be built, which is really important. In our application, then we attracted this big NGO that is dealing with migrants and refugees, and also the biggest municipality here in Bulgaria. And if you are in one team, then you are motivated to act as a team and find solutions, really. If the support is only to the NGO, then the MFI at one point could say, okay, but I have another focus now, so do it by yourself. Really, the partnership from the very beginning to be in one team, the feeling to be in one team and to need to find solutions, this is the important part here.
Thank you.
I think before we have had in the presentation before there was this comment that maybe not only guarantees might be a good tool to support migrants, but maybe also funded inside EU funded instruments. And actually, we had the same internal here discussion that is this, because this is exactly why we participate in this kind of exchanges with practitioners on the ground. For a microfinance institution, is there really a need, for guarantees, which was the maybe more natural solution, or is there even, a need for a loan scheme, for a funded instrument? So I understand that here there is indeed a feedback from Linas, yes, that it would be indeed. Maybe something to further explore in our study, yes?
Yeah, sure, absolutely. I just might comment. It's all over. I'm talking not only to our company, but to all non-bank financial institutions. Like basically, the biggest struggle is to three struggles is how to manage risk, how to get funding, and how to have enough equity. Now, with the risk, it's possible. I mean, that fact, the risk you are compensating with the price. It's very great that there are portfolio guarantees which are bringing that risk down. However, the very big element of the receiving a guarantee from the state is the opportunity to cheapen the funding and to be more attractive for equity investors. That's a very important part of that game. And that's why non-bank financial institutions are very eager to work with the state agencies, because they're getting not only the reduction of credit risk, which would be just a part of the benefit, but they're getting even the bigger part of this benefit, which is the cheaper funding and the higher valuation, the better equity conditions, and etc. And so yeah, and that's how it is with us and with other institutions. Now, what happens further is that that we are very much promote. There is also the interesting limitations also by state that, some kind of contradictions in the regulation that, for example, it is prohibited to companies to credit providers to issue bond emissions if they are not a bank. So the non-bank financial institutions cannot issue bond emissions. They can attract funding only from limited number of sources, and one of those are professional investment funds. So some kind of also limitations there, and yeah, and I very much understand and very much also a believer that the state instrument should be more like a leverage, a facilitators for private investments and private money. And I very much promote that those guarantees, even if our state agencies, EAF, EIB, are willing to more like focus on the guarantee instruments, then to use those guarantees not only as portfolio guarantees, which are covering the credit risk and having the secondary benefit of reducing funding cost and attracting equity, but would more directly work in a way that to provide, for example, a guarantee as for the financial institution when we approach the bank or when we approach the investment fund. In that case, there would be still a guarantee, but specific guarantee for the funding to some financial institution, which then would have an obligation to deliver the benefit for EIF and EIB. My mentioned example with the Lithuanian state agency. They provided funding very cheaply, but they said, colleagues, you have an obligation to provide it with a maximum 6% margin to the small size enterprises, which would mean 7% and interest rate. That extremely low price was for micro lending, because on average micro lending is like 15-20% in the market. Even if when the banks come here in that market, they do not do micro lending for 5%. They do 5%, you know, when they're financing big businesses with the good collaterals. But when it is micro company, no collateral, 10,000 euros, 15% interest rate and not less. So it was very good price and they had very good impact. However, again, the problem was that state funding amount is limited and the program ended. It ended, they provided some certain amount of money and that's it. No more money, just some good impact. If they would use their resources as the guarantee and the private money would be attracted, private investments of investment fund, I think that the scale would be much bigger and they would still be able to deliver the benefit to the market. Thank you. Yeah.
Yeah, Linus, thank you. I see your point. It is certainly we know that. That's why also we have a funding instrument, the European Investment Fund, right? A funding instrument for microfinance providers in order to address this issue. That of course there's a limited scope for funding sources, and also EIF, as you know, has invested also in other investing entities. So basically in the fund of funds that are specialized in the smaller end of the microfinance provider. So there's an attempt to do that. What I just want to raise is, however, you mentioned the possibility that EIF, for example, provides a guarantee to the to cover the microfinance provider risk when leveraging up, when raising funds on the market. And I mean, I think there, if we are already providing guarantees to the portfolio risk of these microfinance providers, we are de facto, of course, reducing the risk of the microfinance provider. You know, in other words, if a microfinance provider has, so an MFI has a portfolio of loans to micro enterprises, to vulnerable groups, and we're providing 80-85% guarantees, then I find it difficult then to argue that we should also, on top of that, provide a guarantee to the microfinance provider for, you know, this de facto the remaining risk of 15%. No? I mean, we are already guaranteeing extensively the underlying portfolio. So that's my spontaneous reaction to that. I don't know if EIF are considering anything of that kind, but I would think it's better to address the issue directly where the primary risk is, which is on the micro enterprise level.
Yeah, I get your point. You are correct that it would be some kind of overlapping of guarantees from that perspective. But then the question is, you know, yeah, still, for example, we as non-bank financial institution, we were approaching a bank, and somehow the bank was assuming that we are falling under EGF guarantee, European Guarantee Fund. And they were providing, again, a funding for us by assuming that, okay, it's a safe case. We were still presenting that, you know, our portfolio is 80% under EIF guarantee. And they said, okay, if there is EGF, then definitely we work with you. If there is no EGF, you know, there are other cases in the market which are falling under EGF, some manufacturing, some services, and etc., and we will finance them. So they financed us by assuming that, and then eventually they found out that actually we cannot be financed, we cannot be under EGF because we are a credit provider. So kind of by coincidence, we received that funding because that was a wrong assumption, and we were kind of happy about that. But we would not be able to get that. So the bank when it considers whom to finance, or investment fund considers whom to finance, manufacturing, services, and credit provider, well, if it falls under EGF, they finance manufacturing and services, and they do not provide loan to credit provider, despite the fact that we are very much using portfolio guarantees of EIF. So I'm wondering, also by having your very correct kind of and fair concern that they would be overlapping, then the question, okay, maybe it should work then in different way. I don't know, but I just know the thing that you know, when we get expensive funding, then end users should pay for that, and I'm not happy about that, because I would very much be willing to, you know, to provide the credits with as attractive price as possible. But due to very limited sources of funding, and due to the fact that we even do not have equal competition there, because on venture, I said, as I mentioned it, we are excluded. On some other guarantees, we are by purpose excluded. Then we are competing. We even can hardly compete, you know, with some regular businesses who are coming and saying, you know what, we will take a loan and we are in the guarantee, and please, you know, provide us a loan. So, you know, that's how it is. That's a tricky situation.
Thank you very much.